On the evening of the 7th of April 2026, as Donald Trump announced a ceasefire agreement with Iran, global financial markets instantly staged an utterly absurd carnival. The following day, the S&P 500 surged by 2.5%, the Nasdaq climbed nearly 3%, and the Dow Jones pulled off a staggering 1,300-point single-day leap. Mainstream media was quick to label this a peace dividend, suggesting investors were celebrating the de-escalation of conflict. The irony, however, is that even after the ceasefire was exposed as a worthless scrap of paper and the situation continued to deteriorate, stock prices remained as steady as a rock. If you truly believe the market was paying for world peace, you are being naive. The truth behind this explosion lies hidden within the cold, underlying logic of Wall Street. Before this surge, the market was in a state of extreme, suffocating suppression. Due to the blockade of the Strait of Hormuz and the looming shadow of an energy crisis, the S&P 500 had just endured its most brutal 5-week losing streak in nearly 4 years. Wall Street was on the brink of collapse. The selling frequency among hedge funds had hit a 3-year high. Data from Goldman Sachs's prime brokerage clearly illustrates the carnage. The sell-off among North American funds surpassed even the early days of the 2020 pandemic. With leverage ratios skyrocketing above 300%, everyone had bet their chips on Judgment Day, and short positions against index ETFs had reached historic extremes. At the time, commodities analyst Rory Johnston even predicted that if the strait remained closed, crude oil would soar to $300, plunging the world into a depression more terrifying than 2008. When everyone is betting on a decline, a single signal, even a false ceasefire, acts as the detonator. The first domino, the short squeeze. When short sellers borrow and sell shares, their greatest fear is a price reversal. Once a positive signal triggers a rebound, a massive number of shorts are forced to buy back shares to limit losses. This forced buying drives prices higher, which in turn triggers more margin calls. The surge on April 8 was, in essence, a collective stampede caused by overshorting. The second domino, CTA algorithmic flipping. The market is no longer controlled by humans, but by rule-based quantitative models, CTAs. Before the ceasefire announcement, these algorithms were net short. However, the moment stock prices broke through specific technical thresholds, the algorithms flipped to aggressive buying. Goldman Sachs records show these machines churned out $86 billion in buy orders in just 5 days, a buying velocity ranking in the top 5 in history. The third domino, option hedging mechanisms. Under a negative gamma regime, options dealers must buy underlying stocks to maintain risk neutrality as prices rise. This creates a self-reinforcing loop. The more the price rises, the more the dealers must buy. Why does the modern market feel so counterintuitive? Because its skeletal structure has fundamentally changed. Blind passive capital. 20 years ago, the market was dominated by fund managers scrutinizing balance sheets. Today, 63% of capital is locked in $13 trillion worth of passive index funds. They ignore fundamentals, buying automatically based on market cap weight. Number 2. The monopoly of multi-strategy funds. Giants, like Citadel and Millennium, rule the industry with high leverage and ruthless stop-loss rules. Once a red line is touched, algorithms execute instantly, regardless of the cost. The frenzy of short-dated options. 0 DTE, 0 days to expiration. Options now account for over 60% of total trading volume, driving over $2 trillion in hedging transactions daily. Conclusion: narratives are merely ornaments. The stock market we once knew, defined by finding value and holding long-term, is a relic of the past. It has been replaced by a gargantuan feedback loop composed of algorithms, passive funds, and options hedges. Those sensational headlines and financial commentaries are nothing more than fairy tale stories humans invent to soothe their nerves when confronted by the cold, mechanical movements of the machine.